Alright, ladies and gentlemen, welcome back to the Simple Markets channel. My name is JB, and today, by the title, you probably already know the point of this video, but I'm going to be talking a little bit about prop firms and what I'm calling the prop firm pandemic. Now, as corny of a name as that is, you guys know I don't trade with prop firms. I actually trade my own personal capital, but I do coach and manage over 50 funded members. I have two trading partners who run the community of Simple Markets with me, Sven Trades, as well as my partner, Andre. And both of them are heavily involved in firms as well. And then we have over 100+ students taking prop firm evaluations and working their way towards funding. So I do have plenty of experience with these firms. I'm constantly surrounded by more information, and I myself used to trade with firms just a few years ago before kind of seeing this tidal shift that's occurring in the trading industry and kind of moving my way away from them. Now, my goal with this video is going to be talking about growing issues within the prop firm industry, not this firm specifically that is on my screen, but as a whole. In fact, I actually think the firm that is on my screen is probably one of the better options for most of you to go with because of their reputation and now going on 10 years of service. But despite all the issues and growing negative trends within the prop firm industry, if you stick around to the end of the video, I'm going to give my takeaway on how I would navigate it, as well as a lot of my students and what they are doing to still capitalize on firms and use them while they can. Because the reality is, yes, within a few years, regulation is likely coming, and a lot of these firms will no longer be of leverage to you. So you need to make sure you have the right mindset and the right plan ahead to still continue your trading journey. Now, for those of you that don't know, essentially the way that firms work, you take what is called a challenge or an evaluation, where you have to pass a certain threshold of profit on the account without reaching a certain amount of drawdown on the account. And they're typically two-step challenges. As you can see here, there's the FTMO challenge. And then once you pass that, followed by the verification, once you are done with that evaluation process, you will become an FTMO trader. Now, a very common misconception is that if you trade $200,000 for FTMO as a live trader, that is real live capital. Unfortunately, that is not the case and is not the proper business model for these types of firms. These firms are now very open and must disclose that they are simulated trading firms, meaning that you are not actually trading that capital. But when you do make trades and profit on it, you are going to be paid out through company funding. And in most cases, the majority of the funding for a lot of these prop firms is made through the failed evaluation. A lot of traders have to pay a fee to take these evaluations. And when they do, the vast majority of traders do fail. And then the company will pay out those small portion of traders who succeed using that profit from the failed traders. Yes, it's not the most ethical model in my opinion, but it does work for those who are successful traders like myself and people in my community. And unfortunately, the reality of trading is 99% of traders who get into this industry won't put the serious time and effort needed to reach the FTMO trader standpoint, or even the point of consistent profitability with a strategy. Now, yes, I understand it can be shady for some people who are new to firms and hearing this information, but I think it is a fantastic way to start regardless, and the majority of my students utilize them to grow their capital from a small starting point. The reason being is with a firm like FTMO alone, you can leverage up to $400,000 in capital. Making small returns on that account is enough for significant payouts. So I do think they are a great way to start for those that are undercapitalized in trading, but I do not think they should be your end goal. With prop firms, there's been two main issues that are kind of growing in the industry. Now, number one, there's a very low barrier to entry to start a prop firm. And a lot of these firms are started in very lenient jurisdictions in many different countries in the world as a way to essentially make money very quick by knowing that the majority of traders will fail their evaluations and the firm will collect the evaluation fee, essentially waiving that high dollar figure value over the head of traders in return for those small fees that they know they will collect on traders failing their evaluations. But because these firms have to pay out the successful and profitable traders using the money that the failing traders are generating for them, there can be some issues in some cases where a lot of firms are beginning to make up or stretch their rule book to a point where they can deny your payouts almost for any reason possible. Now, this firm on the screen, once again, I need to reiterate, is probably one of your better options. They have been in service for 10 years. I am not speaking about this firm because personally, I have not heard of this firm denying a payout yet from any of my students. But there are many, many sketchier and new firms that have popped up in the space that a lot of traders seem to gravitate towards due to marketing, and don't realize that you may pass the whole evaluation, pay your evaluation fee, finally get to that funded trader status that you've been waiting for years, and then your first payout on the account, the firm will turn around and say, you know what, you traded during a news event, we're not going to be able to pay you. You broke our rules, we're going to breach your account, and you must start from scratch again in the evaluation stage. It's extremely frustrating for a lot of new traders. For most cases, it's the nail in the coffin for a lot of traders to go and quit prop firms as a whole. I myself actually landed in that spot years ago when I started using these other newer firms that were popping up in the space due to my main firm that I was using getting shut down. Although I did get some payouts from these newer firms, eventually as my payouts grew and grew, they began denying them for less valid reasons. I believe that one of the biggest advantages to the simple markets community as a whole is having access to traders like Dang or many other funded traders in the community who essentially go and try those lesser known firms, test them out, give a review on it, show their payouts, explain how the process went, the pros and cons and the rules. This is something that you trading as a solo trader will not have access to, and I'm telling you, it is priceless to be able to have this information on new firms and expand your network, because there are traders in our community who are leveraging 8+ firms, millions of dollars in prop firm capital, and trading for payouts consistently with many different firms under their belt. So yes, although firms are looking pretty rough on the surface right now, and a lot of new ones are ruining it for the rest, there is still plenty money being made in the firm industry, especially from a lot of our students here at Simple Markets. Now, another thing to understand here, this may lose some of you, but what I want to explain is because these are simulated trading platforms, these firms have to use what is called a third-party liquidity provider. Now, liquidity providers are who manage the exchange of your orders in the market. In most cases, you are not trading A book, which means directly into the foreign exchange market. You are likely on B book, which means that your broker is essentially hedging against your positions that you are taking. Now, with this being said, firms operate in a similar way with their simulated platforms because they cannot enter directly A book into the live markets in the foreign exchange market. They have to essentially simulate those live markets using their own algorithmic values for things like spread, slippage, swap, etc., all of those different variables. And for someone like myself who traded with a prop firm a few years ago who actually got shut down for tampering with those values to make it harder for traders to succeed, it is something that is extremely apparent to me that is slightly changing in the industry as well. Now, I am not accusing this firm or any firms of doing anything of that nature. I don't suspect any foul play. I need to say that and get that out front here. However, there has been a lot of traders in my community noticing increased spreads with certain firms, and this is due to that simulated algorithmic values that I talked about. For example, one of my students was shorting price on NZD CAD at this position, and this simple candle here, this tiny little bullish candle, was enough to actually stop them out of this trade with a ridiculous amount of spread. This is another example of how this might look, where someone bought at this position and their stop loss was tagged out, despite the candle being way up here and a bearish candle overall. It came nowhere near that stop loss. However, the spread that we're talking about was increased so drastically that it took them out of their position. This is something that is becoming a lot more apparent and really hurting traders, as at the end of the day, this type of terrible trading conditions is going to make it much harder for you to get payouts in the longer term, and the spreads tend to increase drastically lately on a lot of different brokers. And these firms are increasing spread so drastically that it is making it more difficult for newer traders to increase their profitable edge. And even a lot of our traders that are profitable on their live accounts in trading with their own personal capital are finding it a lot harder now to be profitable on certain prop firms due to their change in spread, slippage, and swap, and the increase in those variables hurting their data overall. It may not look like a big deal, but it does make a big difference. For example, I am tagged into USD Chef at the moment. I have a buy position running. I was very easily tagged in here with this huge wick that we have. I know a lot of my students who were not due to the spread on their prop firm. And let's just say this trade goes and runs 3% return. Or for me, because I risk 2%, this is a 6% gain on the account that they may be missing out on simply because of something like spread. This is happening very often as well with some of my traders who don't use a break-even rule. This is another example where it came nowhere near stop loss, but it did end up tagging a lot of them out, and then they didn't get to capitalize on the overall profit on the trade. Obviously, this effect compounded over many trades is showing a huge drastic decrease in their edge and their overall profitability, and it's something that you need to understand when going into prop firms. I will talk a little bit more at the end about the mindset that you need for prop firms and understanding that, yes, it is not real trading at the end of the day. But before that, I'm going to go into some of the solutions that I would personally give to my traders and that some of them have already started implementing. Number one, this is just essentially removing your highest spread pairs. It's going to help mitigate the amount of trades that you are tagged out on, or the amount of losses that you receive due to something like spread. These pairs tend to be a lot higher in spread typically, and if there is some like NZD/USD, for example, where this may be an exception and spread remains fairly low on this pair. But for those that have high spread pairs, it's better off removing those ones from your watch list and maybe lowering yourself down to 20 pairs or so. The strategy will still work just as effectively. We have plenty of traders who actually already do that with prop firms, and they say they find it even easier because they scan less trading pairs per day. It's one simple and easy solution. Now, the second one I would recommend is a little bit more complicated, but this is something that a lot of our students are doing. This is called a copy trading method. Now, what this does is there's certain platforms like Traders Connect where you can have a master trading account. For example, I use Forex.com as my live account. I could link that as my master account and then link the FTMO evaluation as my secondary account. Now, what this will do is any trade, the values that I take on Forex.com are going to be mirrored over to that FTMO account and then placed there as well. This is where it gets a little complicated to understand, but essentially speaking, my trades on FTMO will mirror the variables of the broker that I'm using on my master account, which would be Forex.com, which is a great regulated broker. So when price gets very low to my stop loss, even though FTMO might have a ridiculous amount of spread that's going to tag me out, Forex.com with a lot more favorable trading standards will be able to keep me in that trade because it's copy traded to the master account and will not close until that master account closes. So you don't use the stop loss on the FTMO account, essentially. You're using the stop loss based on Forex.com, but taking the same exact trade. Now, I personally don't do this method myself. I just know a lot of our students who are starting to utilize it because they trade millions of dollars for prop firms and they are still finding whatever they can do to get consistent payouts. It's another reason why I cannot thank the Simple Markets community enough. Is a lot of these guys are top of the line. They took our strategy, they ran with it towards places that I haven't even reached myself as a trader, and I'm constantly learning new methods like that from them, and a lot of these guys are just really smart about what they do in utilizing these firms to the best of their advantage. And last but not least, my always recommendation for you guys is to start a personal trading account. You are going to want to start it with a regulated broker, and typically brokers are regulated in your region. In the US here, we only have 4 regulated brokers. Awanda and Forex.com are 2 that you may know of. I've used Forex.com for a long time now, and I cannot explain how good being able to compound my own personal capital on a safe and regulated broker has been. Now, I do want to explain to most of you, maybe I'll talk about this a little bit more in another video, but compounding a personal account of say $3,000 over the course of 5 years, it compounds continuously because we trade on a Forex broker where every trade continuously opens and closes and adds to the P&L for an additional contribution of say $500 at the end of every month. And then for me, I guess we'll just use my returns, 82.72% for this year. Keep in mind, I risk 2% per trade, so I'm only up about 41 RR, which is still fantastic. Compounded over the course of 5 years, you can see there is significant growth potential doing something along those lines. Yes, it means it requires an investment. Yes, it requires an upfront investment, but that long-term gain in that compounding will pay out dividends on what you can do in the trading space. I know everybody just throws numbers in investment calculator, shows you a huge number and tells you to go do it. Of course, things are easier said than done, but this is just an example of what can be done in the long term with a personal trading account and how it should be viewed. Now, the last thing I do want to mention regarding this problem is that you need to keep your mindset in shape when using these firms. Understand that they are essentially a way for you to use and leverage capital while still being undercapitalized yourself. It's a great way for a lot of traders to start making money. For example, I know traders who have come from $0, entered the prop firm space, made a $3,000 payout, and put that right into a personal trading account to get started. That's the way they should be viewed. Understand that they are not a great depiction of how you are as a trader because I talked about so many of those negative variables that impact your edge. I have literally seen traders have a negative month on their FTMO account, but then have a positive month on their personal trading account, simply due to those variables like spread, slippage, and swap, eating away at their profits drastically, even though they took these same exact trades on both accounts. This video, although went a little bit longer than I expected, I hope it was informative for a lot of you guys. I hope you got a little insight into my point of view and can even make some changes to your long-term plans and goals. Keep your head on straight in this industry. Have good long-term views on what you want and expect out of trading. Understand that if prop firms go under, which they might due to regulation, it is not the end of the world. There are many other options, but use them while you can for the great ROI on your capital. Thank you guys for watching. I hope you appreciate the content, and I will see you guys in next week's video.